Probably you will wonder yourselves how many types of market are out there. Well, the answer is too many. Currencies, commodities, bonds, stocks, crypto, the list is endless. The speculative nature of fast earnings is the first thing you need to discard. No matter how many markets we have, they have all one thing in common: the way that they move. Markets are either trending or ranging. These are the major characteristics no matter what market you want to trade. You need to know the type of market you are trading. Many new traders will complete the games that numbers verify the theory, and indeed 90% of traders lose 90% of their account in less than 90 days. So you need to ask yourself, what is this all about? Well, making money in the financial market is not an easy task. So far we have demonstrated in this channel several tools and how to use them. Indicators, oscillators, all types of analysis and so on. But this is not enough. The most powerful tool you need to grasp is to learn to identify the market conditions. Identifying the main trend and the retracement will take time or might never happen. The market will play tricks on you several times, no matter how experienced you are. We are here to give the tools, but practice will make you better, and not our videos. Of course, the markets are a movable minefield. The place you stepped safely a couple of hours ago now hides a mine that will explode under your account. The market provides many trending and ranging opportunities across different time frames. You need to fill your toolbox with the proper tools, and also you will need time to learn how to use them. Let's try to analyze the market conditions no matter what market you are trading. A trending market, in simple words, is the desire of the market to move in a direction with no specific rules, but rather chaotic. Fundamental indicators, Elliot wave, retracements, support and resistances are here to help you to catch the next wave and try to follow the trend as the market moves in waves. We have two types of trends: bullish and bearish. Trends are usually noted by higher highs in an uptrend and lower highs and lower lows in a downtrend. For most of our videos and examples, we are analyzing financial markets. The principles are the same no matter what market you are trading. As FX traders, usually we pick up the major currencies as well as any other currency utilizing the USD. Liquidity is important in trend-based strategies. The more liquid a currency pair, the more movement we can expect. The more movement, the more opportunities there are for prices to move strongly in one direction as opposed to bouncing around within small ranges. ADX is an indicator that can help you to identify how strong is a trend, and you can find the relevant video in the description. One of the most important tools you can use is the moving averages. In a trending market, you will be killing it by using a simple moving average or exponential. Variations like Bollinger Bands, rebounds, envelopes, and all the indicators we have analyzed in this series. Parabolic SAR, parts of the Ichimoku and MACD. Also, keep in mind that the market works as a part of a self-fulfilling prophecy. The more popular an indicator is, the more reliable will be, as most traders will follow that indicator. It's impossible to identify when a new trend is starting or about to start, even though people that are watching this channel already know what we are capable of doing. For beginners, the easy part is to go with a trend, and for more advanced traders, to identify the trend continuation. Also important are trend lines, as the market loves to follow them. Hidden in the art of trading is identifying the trend continuation. Of course, everything is obvious after the market makes the move. Many gurus will try to scam you like that. The good news is that you can trade the market simply by making a demo account. Try to identify that in live markets. For this part, the market will start building a structure. Being able to identify this structure will ensure you some profitable trades. Our suggestion is to try practice a lot in 1 minute time frames. Identifying the trend in those small time frames will help you to scale it up to more solid time frames. Trend is your friend. For most of the time, the market will be heading in one direction. However, this is not always true. The second important type of markets is the ranging markets. In those cases, the market doesn't have a clear direction as buyers and sellers are coming into an agreement. The market will be trapped in specific key areas, forming channels and rectangles. A breakout is about to happen. We will discuss breakout strategies and how you will be able to have statistics on your side. In ranging markets, the high price acts as a major resistance level in which the price can seem to break through. The low price acts as a major support level in which the price can't break as well. The market has no clear direction. It's also known as choppy market. A choppy market is the opposite of a trending market. In a choppy market, there is no clear direction and the prices chops up and down. Our suggestion as beginner is to not trade ranging markets. Of course, it's not easy to identify that right away. A good and simple way to say if the market is ranging, other than using your eyes, is to use the ADX. I know it might sound strange, but especially beginners fail to see the most obvious things. A reading below 25 means that there is no clear direction. I suggest taking a look at the ADX indicator. The market might drift also as part of the consolidation. It will look like the prices are heading in a direction, but still the higher highs won't be so far away from each other. In choppy markets, you will use Bollinger Bands, ribbons, alligators, and so on. When the lines converge, the market is taking a breath and starts ranging. Bollinger Bands is a good tool for breakout strategies when the bands are thin. When the bands start to expand, volatility is increasing and more movement of prices in one direction is likely to happen. The environment is not recommended to trade. You will have several fake outs and your account will suffer. When big news is about to come out, the market will be in that state. Breaking out strategies are promising, however, the huge drawback is that you don't know if it's a breakout. Most of the time, if we do not have a major event, the market will return after some rallies. The idea of trading the bounces is to buy low and sell high within the range of the channels. Spikes will hit your stop losses. This will eventually make you increase your stop losses and end up losing huge positions. Again, when the channel it is formed, it will be too late to enter the market. We don't know for how long the market will stay in that channel. Always choose to enter the channel using the trend. You can use them while you are already in a trend. When the market is trending in the downside, by selling near the high price, we have more chances for the trend to continue and for us to get a trade. The opposite when we have an uptrend. Recommended tools to use are oscillators like stochastic and RSI. A very popular technique you will also find in the description is the zone recovery technique. We have covered it in a separate video if you are interested. In this chapter, we will explain the characteristics of retracements and reversals, how to recognize them and how to avoid false signals. We have already explained trends and retracements. Now the $1 million question is how to know if this is a retracement or a reversal. Unfortunately, the experience will help you with that. The market will create structures that will be similar. Retracements tend to be more smooth and follow less intense highs or lows. Here you will need Elliot's wave also. An ABC correction happens all the time. New traders dive into the market, but unfortunately the market keeps trending. And this was just a correction. In this example, as the market is trending, this is clearly the retracement. A retracement is a temporary price movement against the established trend. The market is moving in waves. When a retracement occurs, the market changes direction for a small period. This is the perfect moment to enter the market. Sounds easy, right? Well, it's not. Reversals, on the other hand, are defined as a change in the overall trend of price. The main difference between reversals and retracements is the intensity of the move. Usually when the market changes directions, won't be so obvious from the beginning. That's why we don't dive into any trade unless we can identify a trend and the retracement. Trends might change with some well-known patterns or without warning. Indicators won't be so useful at this point. They might detect that the market is changing momentum, but finally the change in the main trend won't be so easy to be spotted. As the new trend is being established, it will be hard to identify from the beginning. Trading against the trend is not recommended when you are holding a position and you don't know if this is a retracement. So the market will be going against you. Do not chase the market. Do not leave your losses running. Only if you see the market is running out of steam. At this point, you can adjust slightly your stop losses. Your initial speculation was wrong. Cutting your losses early will help you a lot. The trend might eventually return and you might regret you didn't leave your trade. Well, it is what it is. It's better to lose a trade than leave your account to suffer. We will discuss in the future about hedging. This technique is simply opening an opposite position to prevent permanent losses. We will discuss this further in the future, so don't worry about that at this point. There are some tools you can use to identify a retracement. There are some key differences in distinguishing a temporary price change retracement from a long-term trend reversal. Retracements usually occur after huge directional price movements, can occur at any time. When the market shoots up at an abnormal rate, a retracement most likely will follow. If this strong movement is with the main trend, it might be a signal to enter the markets. Again, the golden ratio is one of the most important tools you can use. Price retracements hang around 38.2, 50, 61.8 and the levels we have analyzed in the relevant episode. If the price goes beyond these levels, it might be a signal that a reversal is happening. Technical analysis isn't an exact science, which means nothing is certain, especially in Forex market. A technical diagram will provide you with a sweet spot to enter the market. Pivot points is another tool you can use. You can go to pivot points and check the relevant episode. These movable support and resistances can be quite helpful. When the price violates all supports or resistances, it is a sign. Also, traditional old-fashioned trend lines can help you a lot. When a major trend line is broken, a reversal may be in effect. Combining also with candlesticks like spinning tops, dojis and other candles we have described will be very helpful. Practice and experience is the only allies you will have in this battle. The more experienced you become, the easier will be to determine market conditions. The market loves trending. Ideally, what we want is to catch the market's next wave. Identifying retracements from the main trend is one of the most important key elements that will determine you as a trader. Pay attention to Elliot's ABC corrections that will occur very often in the main trend. The market, as it will start trending, will start building a structure that will be similar. Wave after wave will be the main characteristics of the market. Retracements, corrections and dips will help you catch the next wave. Again, technical analysis is not perfect. What will help you with this is the experience and knowing your market. Important news and events might also provide you with some smooth spots to enter your market. Identifying the main trend and the retracement will take time. Nothing is perfect, especially while trading. Again, thank you for watching. Go back, repeat the chapters you are not sure, and trade safe.